Here's the thing almost everyone gets wrong about the Odyssey. We remember it as a story about a man who gets lost at sea for 10 years, but he wasn't really lost. Odysseus knew exactly where Ithaca was the entire time. He could have named the heading. 10 years didn't just happen because he lacked a map. They happened because of his ego, because he couldn't resist what was beautiful and dangerous, and because when he had to choose between two bad options, choosing felt impossible. And that is the most accurate description of a failed retirement plan I have ever read. Almost nobody blows up their retirement because they didn't have the end destination in sight or know where they were going. They blew it up because of the decisions they made on the way. I'm Justin Kuntz, a certified financial planner and managing director at Pacific Wealth Management here in San Diego. And I help high net worth families retire early and pay less in tax. And on our logo, you'd see a compass. There's probably a reason half the advisory firms in the country have an anchor or a compass in their logo. As advisors, we're really doing our best to help point the way, to help guide our clients to reaching their goals, to do the things that they enjoy, to do the things that they love. And Odysseus, on his journey, probably had a compass as well. He knew where he was going. He knew the direction of where he was going. But along the way, decisions that are being made really influence how that journey looks and how successful that journey is. And some of those decisions around organizing his home, how to get there, building that home in the first place, all these things are really analogous to financial planning in general and the work that we do. So in today's video, I'm going to show you three things. First, the 3 decision failures that sink plans, that also sunk Odysseus, and all 3 are in the poem, between the Sirens, the Cyclops, and the Strait, all things that metaphorically I see quite a lot in meetings. Second, I'll walk through 2 couples with identical portfolios, both experiencing the same bad market scenario, and how the decisions they make during those bad market scenarios are what make or break their success. Sometimes the difference can be well into the 6 figures in that scenario. And finally, the thing that actually got Odysseus home, because it wasn't actually courage. So let's get into it. So here's what you've been told. Get educated, stay informed, and you can trust your own judgment. And broadly, that's pretty good advice. But what does pride actually do for you when you're under the gun or in a pressure scenario? Odysseus blinds the Cyclops, gets his crew safely onto the ship, and he's clear, free to go. And then he can't help himself, and he sails back into shouting range to tell Polyphemus his name. He needed the credit, and that one sentence hands Poseidon a target and buys him a decade of storms. I see the financial version constantly, and it never looks like arrogance from the inside. It looks like competence. It's the executive who's earned 600 grand a year for 15 years and therefore assumes the plan must be fine and he won't sit down and actually run it. It's the person who's been right about one thing, the concentrated stock, the real estate move, the timing call in 2020, and quietly promotes that into being right about everything. Pride doesn't make you ignore the data. It makes you not go looking for it. And so the tell is simple. If you can't say your withdrawal rate, your effective tax rate, your success probability out loud, you don't really have a plan. You have a track record. And those are not the same thing. And only one of them survives a bad decade. The second failure is temptation. And Homer is remarkably specific about it. The Sirens don't attack anybody. They don't have to. They sing, and the sailors steer themselves into the rocks. That's the whole mechanism. The danger is that it sounds wonderful. Every genuinely destructive financial product I've watched land on clients' balance sheets arrived the same way. It sounds wonderful. The pre-IPO allocation a friend got you into, the private deal with a 15-page teaser and no actual audited financials, or the structured note where there's nobody in the room, including the person selling it, can explain the downside scenario. Now, notice what Odysseus does, because this is a planning lesson, not a willpower lesson. He doesn't tell the crew to be strong. He gives them beeswax to plug their ears so they can physically not hear it. And knowing he'll break himself, he has them lash him to the mast and orders them in advance to ignore anything he says while he's tied up. He legislates against his own future judgment. And that's what an investment policy statement is. That's what a written allocation rule is. That's what an automated rebalancing schedule is. You decide once in a calm room, and then you take the decision away from the version of you who will be listening to the music. See, the system does what willpower won't. That's not weakness. That's the most sophisticated move in the entire poem. The third one is the most expensive, and it's the one people don't recognize as failure at all because it feels like a responsible thing to do. Odysseus has to sail through a narrow strait. One side is Charybdis, the whirlpool. If it's active when he passes, the ship and everyone on it is gone. The other is Scylla, who will take exactly 6 men, guaranteed. No version of this passage is safe. And he picks Scylla, a certain bounded, survivable loss over a small chance of total loss. He makes the call and he sails through. The financial mirror is the person sitting on $900,000 of cash for 3 years, waiting for clarity. They believe they've stepped out of the strait. They haven't. They've chosen Charybdis and called it a cautionary move. Cash carries a guaranteed real loss to inflation and a much larger opportunity cost. And the fact that it arrives quietly on a statement that never actually goes down is exactly what makes it invisible. Refusing to choose isn't neutral. It's a choice with the worst disclosed price tag on the menu. Let's make this concrete, the way I'd model it in a meeting. 2 couples, both 58 years old, both with $2.4 million, both spending about $130,000 a year, both about 7 years out from retirement. Same allocation. Now, run them through a 2022 style year. The portfolio drops about 21%. So both are looking at roughly $1.9 million as a result, and the headlines are as bad as headlines get. Couple 1 has no written plan, just a broker, a general feeling that they're diversified, and an understanding that they'll reassess if it gets bad. It gets bad. In October, they move essentially everything to cash and understand that decision felt like relief, not necessarily panic. Then they wait for it to feel safe again, which takes about 14 months. And by then, the recovery has largely happened without them. In our modeling, sitting out a roughly 30% rebound while earning cash yields leaves them somewhere near $2 million against the $2.45 million that they could have had. That's a $400,000 decision made in a single afternoon. And it will never appear on any statement as a loss. It appears as a sale. Couple 2 owns the identical drawdown, but they have a written policy, a target allocation, rebalancing bands, and 2 years of spending already carved out in short-term bonds and cash. That's their beeswax. So the decline is unpleasant, not as existential, and the November conversation in my office isn't, should we get out? It's what's on sale. They rebalance back to target, which mechanically buys equities at the bottom, and they convert $180,000 from pre-tax IRA to Roth at depressed values, filling up the 24% bracket. So the entire recovery on that money comes back tax-free forever, worth another $50 to $60,000 in avoided future taxes by our projections. Same market, same starting portfolio, same news, but the gap between them is close to $500,000. And not $1 of it came from a better forecast. It came from having to decide in advance. Now, I know what you're thinking. Justin, this is a 3,000-year-old poem with a cyclops in it. Where's the comparison? Where's the metaphor? And to be fair, the metaphor doesn't allocate a portfolio. But here's what 2 decades of behavioral finance research keeps confirming in far drier language than Homer used. The gap between what investment returns and what investors actually earn is driven almost entirely by behavior. Buying late, selling early, abandoning the plan under stress. The poem didn't invent that. It just named the failure modes first and named them better. So what actually got Odysseus home? If the first 3 failures are ego, temptation, and refusing to choose, what actually worked? It was Athena. And this is the part I'd like to underline. The most cunning man in Greek literature does not get home on cunning. He gets home because the goddess of wisdom shows up repeatedly, tells him things that he cannot see from the inside of his own situation, and occasionally tells him to sit down. Outside counsel isn't a substitute for his intelligence. It's the correction for the fact that intelligence doesn't see its own blind spots. Now, this isn't a one-size-fits-all dynamic, and I'd be doing you a disservice if I pretended it was. If your situation is genuinely simple, one job, index funds, a paid-off house, spending well under what you produce, you may not need much more than automation and patience. If you're 10 years plus out, you have the best version of this problem because you can build the rules before you ever need them, which is far cheaper than installing them mid-storm. The point isn't complexity. The point is that the decisions get made in advance, in a calm room by someone who isn't inside the fear. So if you're within 10 years of retirement and you want to know whether your plan survives the strait, your real withdrawal rate, your actual tax exposure, and where your plan depends on you behaving perfectly in a bad year, this is exactly the work that we do at Pacific Wealth Management. As a fiduciary firm, we're legally required to act in your best interests, and the first conversation is of no cost, with no obligation and no pressure. You'll walk away knowing exactly which of the 3 failures your plan is most exposed to and what the written rules would look like for you, whether or not you ever become a client. There's a link in the description below to get started. Thanks for watching, and we'll see you in the next video.